The stock market is absolutely on fire right now, and some of my favorite stocks are climbing at a really rapid rate, but I still think there's a long runway ahead for some of these names. I'm going to go through 4 stocks here today that are my favorite growth stocks. I have recently added more to them in the asymmetric portfolio, and in this video, I'm going to tell you exactly when I did a spotlight article on them and what the returns are since then, so you can get an idea of the kind of companies I'm covering on asymmetric investing, and show you just how bullish I was months ago with some of these names that are hot just in the past week. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. And don't forget to subscribe to Asymmetric Investing. You got a link to that below in the show notes. It's also on the screen. That's where I'm covering stocks that have 10x potential over the next 10 years. And the portfolio is absolutely crushing the market in 2024. So check that one out. I'm going to be back in just a second with one of my favorite growth stocks right now. Heads up, folks, interest rates are falling, but you can lock in a 6% or higher yield with a bond account from public.com today. And this is a pretty big deal because when interest rates drop, so can the interest you earn on your investments. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. And you can see on the screen an example of what this looks like. The great thing is you know exactly what you're buying. So while other people are out there watching their returns shrink, you can sit back with a regular interest payment, but you might want to act fast because your yield's not locked in until you invest. The good news is it only takes a couple of minutes to sign up at public.com, lock in a 6% or higher yield with a bond account only at public.com/ASYM. I'm going to start today with SoFi. SoFi I covered on asymmetric investing on March 6th. Since then, shares are up 92%. So this is a stock that in a little over 6 months has nearly doubled in value. And when you start to look at the numbers, you can see why. Let's start by looking at segment growth. Now, the biggest segment for SoFi today is still the lending business. That's really what the company was built on, but it's become less important for the company over the past few years. You can see that as of the most recent quarter, about 49% of revenue came from non-lending sources. But lending's still a big business, still a profitable business, and it's likely going to grow as interest rates fall. But the 2 categories that I want to highlight here are technology and financial services. The technology business is really building the technology behind SoFi, at SoFi's business in general. So the ability to issue debit cards and credit cards and offer stock trading and bank accounts, all of that technology, once it's built, SoFi could just use it for itself, or it could sell that product to other companies. These aren't necessarily direct competitors, although SoFi does sell these products to direct competitors in the banking industry. Some of these products are going to things like HSA accounts. Optum, for example, has HSAs, and so you get a little debit card that you're actually able to pay your bills with. Well, Optum is not a bank. It's not a credit card company. So who's going to do that work on the back end? It's going to be a company like SoFi. So that's what that technology business is. And you can see that over the past couple of years, 45% compound annual growth rate. The bigger growth rate is in financial services. And these numbers are just astounding because this is now a $704 million business over the past 12 months. But just since the end of 2022, the compound annual growth rate for financial services is 127%. So just a phenomenal growth business within SoFi. And this is the company getting into all the financial services that most big banks are doing. So stock trading, investing, they have IPOs, they're doing margin loans, all kinds of things that you can do on a traditional brokerage, you can now do within the SoFi app. And so this is just expanding the use cases that customers have within SoFi. And one of the best indicators for growth for SoFi is the number of members or the number of customers that are using the company's products. That is now over 9 million and has a compound annual growth rate of 58% since September 2020, so over the past 4 years. So I think this growth is going to continue for SoFi. There's going to be blips in the road, but long term, the company has such a big advantage over the traditional bank competitors. Think about just driving by your local bank. They have a giant store. They probably have a drive-through. They have ATMs. They have people working there. They have physical infrastructure. That's all costs that SoFi does not have to incur. So they're able to scale their business more effectively, and they're able to do it in a relatively capital-light business. In the lending business, they're starting to work with third-party financiers who are going to take on the risk of the loans that SoFi is originating. So this is pretty common in the mortgage business, but it's not as common in something like personal loans. That's what SoFi is going to be doing. Personal loans, student loans, and growing in mortgages as well. If they're going to originate those loans, it's going to be much more like a fee-based business, and then they're going to offload the risk, and that would be interest rate risk, default risk, to their financial partners. That allows SoFi to grow faster, grow more profitably, and grow with less risk in their business. Looks much more like a tech company today than it does like a traditional bank. So that's why one of the reasons that I love SoFi's business today. And like I said, shares are up almost 100% since I covered this in March. But I said that then the company could 10x over the next 10 years. So that means there's still 5x potential, and maybe even more than that with SoFi if they're successful in being a top 10 bank in the US. Another company that falls in this disruptive category in finance is Robinhood. A lot of similar products to SoFi, and really the thesis is relatively similar between the two. They're a digital first product competing with companies that have brick and mortar infrastructure, old technology, and so that's how they're going to be able to disrupt their competitors. And you can see from the growth in assets that are being added to the platform. These are net deposits on Robinhood, that the company is gaining momentum. Yes, it was a very hot stock, very hot commodity during the pandemic, but over the last few years, a lot has changed at Robinhood. They are focused more on retirement accounts. That is up 9x over the past year alone. They're also having a lot of success with Robinhood Gold. That's a product that I have, but really compelling value proposition, and really makes them much more like a membership company. I've compared them to Costco in that you're going to pay for Robinhood Gold, which is typically $5 a month or $50 a year, and then you get benefits for that membership. So you get deposit benefits. You can have a credit card that gets 3% cash back. There's lower margin rates. There's higher interest rates on the cash that you have on Robinhood. So all of these things are giving you an incentive to bring your assets, your trading, your retirement accounts, everything to Robinhood. And once those assets are there, there's a lot of different ways that Robinhood can make money, whether that's payment for order flow or margin accounts, or making money on credit card balances. What you have to do is get the users and get the assets onto your platform. That's the hardest thing, to get that flywheel going. And in the meantime, they're generating revenue and basically pure profit from that Robinhood Gold membership. So they're playing a different game than a lot of their competitors, and I think they've been really successful in doing that. It's a much more mature company today than it was just a few years ago. Not as much YOLO trading. The amount of assets per account is going up at a pretty rapid rate. And like I said, they're moving now into more retirement accounts. So that's exactly where you want to be. It's going to be more of a slow and steady growth. Vlad, the CEO and founder, has talked about riding the wave of millennial wealth. This is a group of investors that did not have as much wealth as previous generations at this current age, but they're going to be inheriting tens of billions, hundreds of billions of dollars worth of wealth over the next 10 or 20 years. So these are waves that Robinhood can grow the business. On top of that, one of the reasons that the shares have been up so much recently is Robinhood does have a pretty big crypto business. That's been down a little bit over the last few years, which is the case across the board for the crypto industry. But as crypto has gotten more popular, it's likely that some of that trading is coming back as well. So that's going to be a nice business for them and a nice growth business for Robinhood long term. That's one of the reasons there's a short-term pop, but long term, the story is that assets are moving to the platform. This is going to be a competitor that's going to be able to be more cost effective than most of their brick and mortar competitors. And that's why they're winning market share. And I think that will continue for the foreseeable future. I covered Robinhood on March 30th, so about the same time as SoFi. Since then, shares are up 74.9%, so just phenomenal returns. And I'll put a link in the show notes to all of these spotlight articles. They are on the premium side of asymmetric investing. But that's where you can find this research in long form, much more detail there about my long-term thesis about these companies. The third stock today is Coinbase. Coinbase is one of these companies that has gone from being a investor favorite a couple of years ago to completely down and out. Even their bonds were trading at a huge discount. Investors thought that the end was near for Coinbase. And that's actually when I got bullish on the company. I did the spotlight article, and like I said, I'll put this link in the show notes. On June 1st, 2023, at that point, shares were trading for $63.57. Shares are up just about 400% since then. And the reason is Coinbase is a very different company today than it was back then. The trading business, which was a vast majority of Coinbase's revenue during the pandemic, and that was growing phenomenally, very, very profitable business, that went through a huge decline during the crypto winter, but that's recovered over about the past year. Should have a pretty good fourth quarter as well. It looks like trading volume, according to CoinMarketCap, is up about 2x, maybe 3x in the fourth quarter so far, doing about $6 billion per day in trading volume on the Coinbase exchange. So that should be a pretty profitable business, but really the future of this company goes beyond trading. I think of Coinbase as having the potential to be the JP Morgan, the AWS, and the Google identity of the Web3 future. And when I say Web3, I'm not talking about crypto and NFTs like we thought of them in 2021, 2022. I'm talking about very real financial transactions that you're making with businesses, with friends, digital assets that you're buying. There are very real companies getting involved in this, and almost all of them are working with Coinbase. Stripe recently spent $1.1 billion to buy a company that enabled more stablecoin transactions. BlackRock is building tools with Coinbase and wants to tokenize stock trading and bond trading, be able to settle those things immediately instead of settling over a couple of days, which is standard today. If you're familiar with the bond market, very illiquid, very hard to find buyers and sellers depending on what sort of bond you're looking for. So you could just put all of these things on the blockchain. It would be a benefit for everybody, make everything more cost effective, and it would be a huge tailwind behind Coinbase's business. And just look how quickly this business has grown over the past couple of years. Coinbase's non-trading revenue is now $1.8 billion on an annual basis. That's primarily stablecoin revenue. That's going to be revenue that's from the USDC token, which Coinbase started with Circle. They get revenue based on how many assets are in that token, because backing that token is real dollars that are invested in things like treasuries and bank accounts. So they're generating interest. That interest makes its way to Coinbase. But then there are things like custodial fees. That business has doubled since June 2023. Subscriptions and services more than doubled since that time. And blockchain rewards. This is going to be things like staking. That is now nearly a $600 million business for Coinbase. And there's a whole bunch of businesses for Coinbase that we don't see a lot of impact from. Some of their developer tools, the base blockchain is going to be hidden in these numbers. At the end of the day, if we're doing more transactions on the blockchain, don't just think about cryptocurrencies, think about stable coins. I think that's really going to be the future of this industry. Coinbase is going to be able to generate revenue in a number of different ways. They have the wallets because they have the infrastructure to help companies make that happen, whether that's trading or wallets or cloud services or the base blockchain. There's a lot of different ways that Coinbase is going to be able to make money from this. I think this is a multi-decade tailwind behind Coinbase. So the growth that we've seen recently is just the beginning for the company now. Speculation has really taken over in cryptocurrency, so that makes me a little bit more hesitant buying than I was buying shares when they were $65, $70 per share. But that doesn't mean that the long-term growth for this company isn't going to be tremendous. So long-term, I continue to be extremely bullish on Coinbase. The final stock today is Hims and Hers. I covered Hims and Hers on May 24th, 2024. Since then, shares are up 71%. And a lot of that has come just over the past month or so as the company has reported earnings and we get a little bit better idea what the future growth prospects look like. Just look at these growth numbers from Hims and Hers. And I included net income on this chart as well. There was some tax benefits in the most recent quarter, but Hims and Hers has turned to net income profitability. What was crazy in the most recent quarter, third quarter of 2024, is the company reported 77% growth and expects fourth quarter growth to be 90%. Now, a lot of the attention around Hims and Hers is related to GLP-1 products. These are the weight loss products that have become very popular, really tremendous growth in a lot of the pharma companies because of GLP-1s. Most of those products are still on shortage. And what the FDA does is they allow for compounding, or basically mixing of these drugs in a generic form that Hims and Hers can sell without selling the branded product. That has been a growth driver over the past about quarter and a half for Hims and Hers. But investors are worried that that business is going to go away as that shortage ends. That absolutely could be the case. What I think we're missing with Hims and Hers from an investment perspective, and this may be turning around, is that this is not a company that's really dependent on GLP-1s. 40% of their growth in the number of subscribers that they had was not related to weight loss or GLP-1s. GLP-1s just hit the company's business in June. So that revenue chart that I showed earlier, only a small amount of revenue is coming from GLP-1s today. So this would still be a phenomenal growth company without GLP-1s. And that's because they're building a platform. They're building a relationship with their customers and then offering them more and more solutions over time. So if you think about the competition, whether you're looking at ED, hair loss, weight loss, those are the three main categories today. but that will expand to more and more categories. And the competition for hims and hers is you going to a doctor and having a conversation with the doctor. You got to wait in a waiting room. You only have a few minutes to talk to them. They're only going to take a certain amount of information, and then they're going to make a prescription. That prescription may not be ideal for you. So if it's not, you're going to have to do a follow-up. You got to go to the pharmacy, wait in line there. The hims and hers platform is fully digital. So you do have to meet with a doctor. That's who's going to give you a prescription, but then they're going to follow up with you on the app. They're going to make sure you get the right treatment. There's more personalizations that hims and hers can offer. They have injections, pills, gummies are coming. I think what's being misunderstood here is how much of a platform hims and hers is building and how much that platform could be a better solution for most consumers than the traditional healthcare system that we have today. It's going to be able to serve more people because you don't have all that friction involved in going to a doctor, and it's going to probably be able to serve them more effectively as well because you do have that ability to personalize. So that's why I think there's a ton of growth potential for hims and hers right now. Over the past year, just $1.2 billion worth of revenue. That number could literally go up 100x, and this would not be the biggest pharmacy in the country. So a ton of growth potential for hims and hers. I love a company growing at 77%, 90% based on their guidance for the fourth quarter, and I think that growth will continue. Shares are up tremendously, but I think there's still a long runway ahead if you're a long-term investor. This is another one that I added recently, and I'm looking to add more if there's any sort of pullback. So 4 stocks I'm extremely bullish on. They've gotten much more expensive in the market, so keep that in mind. Be ready to take advantage of any pullbacks. But SoFi, Robinhood, Coinbase, and hims and hers, which one is your favorite? Leave your comments in the comment section below. And don't forget to subscribe to Asymmetric Investing, both here on YouTube, but then also my newsletter as well. That's where you're going to get all of my research first. There's a free newsletter, and then all of my deep dives, all of my earnings coverage comes from that premium side, just $100 a year. So I think the value speaks for itself when you look at those returns. But let me know what you think about those stocks in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.